Okay, well, it has been that kind of a day. You really can't complain if you are a bull because it's been fairly steady. The thing is that if you decided to buy in the morning and then were hoping for, a big sort of pop-up update, that hasn't happened. But no volatility, completely steady. And the good thing perhaps is that there are lots of pillars to today's up move. It's not just a very narrow one sector, one horse race kind of a move that we've seen today. This is Closing Bell. I'm Surabhi Upadhyay, and with me this afternoon is Prashant Nair. Hi, Prashant.
Surabhi, hi. I must say, in a way, globally speaking, the game has changed. And the game has changed simply because if you believe that the biggest incremental mover of stocks is the Fed and what the Fed action is likely to be, then what the Fed is now telling you as of last Friday is different from what many believed that the Fed would do over the next 12 months or so.
Yep.
So I think in that sense, this is a new year, 2019. The Fed saying, and this happens not very often, I must say, but the Fed essentially saying that we are listening to the markets. And at a stage like, the setting was very clear. Equity markets in the US had a terrible last quarter of 2018. Very wobbly, very volatile. And we've all seen that. And then in that context, and also add to the fact that data, that is the jobs number, was very, very strong. And after that, in that kind of a setting, the chair of the Federal Reserve coming out and saying that we are watching the markets, we'll listen to the markets, and nothing is on autopilot, and we'll change strategy if need be. I think, that's the reason I'm saying the game may have changed in a good way. If you're a bull, I think it's all, in a way, all clear, right? The Fed put is very much alive. If the market gets into trouble, the least that the Fed will do is not do interest rate hikes. If there is real trouble, then you can actually expect some help from the Federal Reserve. So I think it's a good one. And of course, there is stimulus from China. It may be piecemeal, a little bit here, a little bit there, but it is happening. So I think a fair bit of help from policymakers coming through at a critical time. Surabhi.
Well, I take your point. I think, central bank versus governments, this is a global situation. It's not limited to India alone. So without talking more about the Fed right now, I just want to point out some stocks here. Today's been an interesting day because we have no complaints. As we just said, banks are supporting large cap IT stocks like TCS, Infosys looking good. You've got buying back on some auto names. But on the mid-cap side of the market, some of the large mid-caps, actually no longer mid-caps, many of them are qualifying as large cap stocks. That's where selling is still very apparent. To look at Ashok Leyland, look at, for that matter, Bharat Forge, look at what's happening to Page Industries. So these are interesting pockets, and we're going to be talking about a lot of this as we go along. Let's get started. Here's what's lined up on Closing Bell today. The market is tracking gains, but it is slightly off the highest point of the day, with key indices up now 0.6%. Reliance and banks like Axis, ICICI and HDFC Bank lead the up move. We will be discussing all of these fundamental trends with SP Tulsian of sptulsian.com. Mayuresh Joshi, fund manager at Angel Broking, and Siddharth Sadani, vice president, equity advisory at Anand Rathi.
Okay, 2018 was a mixed year for equities. How will the markets fare in 2019? Which are the stocks and sectors one must watch out for? We ask our alpha manager of the day, Pankaj Tibrewal, senior vice president and equity fund manager at Kotak Mutual Fund. You'll hear from him on the show.
Will earnings pick up in the third quarter, or is it going to be another damp squib? We get you a view from London. Ayan Mukhopadhyay, who keeps a pulse on what the FII investment sentiment is like on India, joins us from the UK today. And he'll, of course, take us through their market call for the time being as well.
Okay, and as always, our technical experts will take you through the trades for the last hour of trade. We'll have Ashwani Gujral and Mitesh Thakkar joining us on the show. Ashwani and Mitesh are with us right now. How should you position yourself in the last 1 hour of trade? Let's get it from the both of you. Ashwani, first up, what is your reading? I heard you the last couple of times, and you essentially were saying that, well, the markets after this gap up has not been able to do anything post that. So in a way, it might be strong, but to what end?
See, the issue is that this rally is now 2.5 months old. So the Fed chairman is a little late in saying whatever he said. And my sense would be that maybe the market had priced that in, because finally, what does the US Fed do all the time? Prop up markets, inflate asset prices. At these levels, that's kind of in the price, because the markets continue to move higher even when he was hiking. So that way, given the way markets have moved, it doesn't look like they are greatly enthused. Even, the Dow Jones futures are up hardly 37 points. So I would think that, given that now we are not able to cross even 10,850 in any sort of hurry, I think there is profit booking because we have domestic, higher bond yields, etc. All that is happening. So if you take the bank nifty out, actually the nifty hasn't done a whole lot. So that way, we have taken some put positions on bank nifty, some kind of, profit booking on the nifty, because it doesn't look like the markets are greatly enthused with these sort of statements. Now, what is the upside? Could be 100 points, 10,950 we know has not been crossed very easily. So my sense is that, a lot of the good news is in the price, and when it looks very good and all the problem areas are over, sometimes, the markets also have made some sort of a top. Having said that, individual stocks, Indigo is a sell with a stop of 1130, target of 1090. Bank of India is a sell with a stop of 110, target of 104. And Kolte Patil is a buy with a stop of 268, target of 282.
Okay. Interestingly, Ashwani mentioned Bank of India. I was looking at PSU banks right now. This slightly lower. As of now, not too much of a reaction to the fact that the bond yield has risen quite a bit. You'd have to take note. Now it's at 7.51, by the way, after statements came in from the Reserve Bank of India. And he seemed to indicate that he's in no quick mood to go out there and, open up the purse strings and put more liquidity in the market. Sort of made very prudent comments about the current liquidity situation, and also, of course, the right kind of noises about farm loan waivers and, things like that, saying that they all come at a cost and disturb the borrowing discipline. So anyway, that's the yield. Right now, banks are doing okay. Bank Nifty is still holding on to 27,400, and PSU banks aren't falling too much. It is a day's low on that index, but there's no major slide on PSU bank stocks. Let's take this conversation to Mitesh now. Good afternoon, Mitesh. What are your bets for the last hour?
Good afternoon, Surabhi. So for me, I think the market still remains indecisive, and we've not seen any kind of trending signal. So maybe I think, because we're just about 10,725, I think that we might just do this range of 10,930, 950 to about 10,720, 750. And we are somewhere in the middle. The current stock calls which I have are a buy on Cummins with a stop at 830 for targets of 870, and IDFC is a buy as well. Keep a stop at 44, look for targets of 47.5.
Okay. So those are the last hour trades coming in from both Ashwani and Mitesh. The markets were up 62 points. I mean, it's actually come off a little bit in the last, 10-15 minutes or so. So we'll keep a close eye. SP Tulsian, Mr. SP Tulsian of sptulsian.com and Mayuresh Joshi of Angel Broking are also joining in. Ashwani and Mitesh stay on with us. Mr. Tulsian, first up, a quick few words on the market itself and whether you feel comfortable going long here. What would your broad thought process be at close to about 10,800?
See, Prashant, on Friday morning, since start of the day, I've said that the volatility which we were expecting in the first week, which we generally see in 5-week series, was over. And on Friday only, in fact, we have said that it will be quite positive for the traders, those who initiate the longs, overnight longs, and the same view continues. Because if you really take a call on the Bank Nifty, because Bank Nifty seem to be driving the Nifty as well going forward. And this Thursday, the Bank Nifty is likely to happen or maybe expire on a positive note. And that will see the interest, remaining alive in maybe non-Bank Nifty stocks like HDFC Limited, Reliance Industries, ITC, L&T kind of stocks, or maybe even one can add Maruti going forward from here. So if you have these kind of data points or these kind of analysis, then obviously you need to remain long, and we keep the positive view for entire week. Maybe barring for a few, some kind of profit booking coming in at a higher level, maybe in the next 2, 3, 4 days also. But overall, the bias should be positive and remain long for the entire week.
Pull up one stock again. Look at this one. Eicher Motors is in negative territory. We are looking at 20,080 and counting on Eicher Motors. Look at that slide come through after the stock fell off 14%, Prashant. It was such a rough ride for Eicher last week. and it seems that it's not entirely done. In fact, Ashwani, let me toss this stock to you. Considering that the bears are refusing to let go of this ride, would you still look at a trade on iShares, or do you think it's sort of most of the downside is taken out?
See, my sense is that both iShares and Page are getting derated because a lower level of growth needs to be priced in. So I would think, iShares probably will get up to 15 to 16,000 before it stops. It had a mild pause and again it started to fall. So don't try to get into iShares because a lower PE level, a lower profit growth, etc. We saw what happened with NBFCs. I think a similar derating is going on out here.
Just to broaden that to autos, Mr. Tulsian, do you expect the third quarter, the October to December numbers to show up in a poor way for margins for auto companies? Because this slowdown, no one knows how long it will last or whatever. But operating leverage can play in a very negative way as well, because companies primarily are focused on maintaining market share. But at what cost could be the question if there is slowdown?
See, Prashant, maintaining market share may not be the case with all the companies. One can be selective, saying that Bajaj Auto has been, focusing more on maintaining market share. And what you say is right, that the operating leverages will definitely be taking a hit in Q3 because we have already seen the sales figures in front of us. But again, you can pick and choose. Now take for instance, which I have said in case of escorts. If you take a call on the YOY basis, there has been 37% growth. So I don't think that the escorts numbers will disappoint. And even coming on the Maruti also, after having corrected so much a while back, I've said that Maruti, we are keeping positive view from here on. Because the pain points which are seen in the sales of the automobiles, largely on the passenger vehicle front, is seen more for the month of January. And I think from month of February and March, again things will start picking up because liquidity is seen happening. The petrol, diesel prices have fallen to a new low. And all the the headwinds or the negative data points which we have been seeing for the automobile sales are seen to be behind, including change of the calendar year. So we are keeping, in fact, positive view, maybe on a select basis from here on, like Maruti and Escorts, or even for that matter, M&M, because the kind of erosion in the values which we have seen in the share price of all these companies have largely factored in all the negatives. And mind it that the companies have raised the product prices also. And if Maruti is saying that 8% growth can be looked into, that itself, when we have a negative perception for the entire industry, 8% growth itself is seen to be good. And you only point is that you can't have a short-term view or maybe near-term view. These are the portfolio stocks or maybe the quality stocks like Maruti, M&M, or maybe Escorts. So you need to have a little longer time horizon of at least 6 months. So we seem to be a process of bottoming out these stocks maybe in next 15 to 20 days.
Okay, all right. So that's Mr. Tulsian's call on the auto space. Mayuresh Joshi is also with us this afternoon. Mayuresh, earnings season is upon us. IndusInd Bank is going to be off the mark as well this week. Stock's actually doing quite well today, up 1.5%. What would you expect from this one? The interesting bit is the stock hasn't done too much in the last couple of weeks. So it's approaching the earnings, in a very muted fashion.
Afternoon, Surabhi. Oh, absolutely. And again, if you go by the past quarter's numbers, I think the numbers were quite reasonable. So if you look at the advances growth in excess of 31%, they were able to maintain their NIMs at 3.8%. And even on the asset quality front, GNP is at 1.08, net NP is at 0.48. I think that was a show that one really expects IndusInd to probably exhibit. At the same time, I think when you're probably talking about the advances growth going forward, specifically in terms of consumer financing, where I think vehicle financing forms a huge chunk, I think the slowdown that we're probably seeing in volumes and what kind of an effect does that have in terms of the advances growth, specifically towards CV financing, is going to be very, very critical in this quarter and the next quarter's numbers. The second element obviously is the corporate lending, which is almost 60% of their book. And again, it's a diversified book. So the expectations lie largely are that a 25% plus kind of an advances growth is something that the bank should probably and ideally exhibit. When you're talking about asset quality numbers, I think on an absolute basis, I think it should be relatively in line with what the street is expecting, around the same mark that we've probably seen in Q2. Provisioning might actually go up. So PCR at 56% odd at the end of Q2 might actually start inching up for a few risky accounts that the management probably had alluded to as well. So to that bit, again, I think numbers should more or less be in line with estimates. It's just the valuation matrix that one really needs to work out with. So expecting a steady set of numbers, in my opinion, on all counts from IndusInd Bank.
Low on the Nifty, just 45 points left. I mean, when we took that break, there was still about 60 odd points left, and there's a sharp drop which is happening as we speak. So 10,773. The Bank Nifty should come up on your screen as well, and we'll quickly take stock. I think 0.5% left on the Bank Nifty, and that is also almost at the day's lowest point. Actually, it is at the day's lowest point. The small cap index, Surabhi, is almost slipping into the red now.
Yeah.
So 6387, and we'll have the mid cap index, which is with mid cap index is also almost in the red. I mean, 0.06% odd left on the mid cap index. So this is an across the board sell off which is happening as we speak.
Yeah, I completely take your point, because on the Bank Nifty, I mean, you've got the likes of ICICI Bank, which are contributing to the downside, Reliance, TCS, a lot of the other big stocks as well. Everything that was supporting the market till now, all of it has come under pressure. But I just want to single out some of the housing finance stocks. Take a look at the knock on Indiabulls Housing Finance, or on DHFL for that matter. That's a little more exaggerated. 3.5% gone from Indiabulls Housing Finance. And DHFL is also under pressure. That's quite a bit of a sell down coming in. Mr. Tulsian, do you want to comment on this, sir? Some of these housing finance stocks suddenly looking a little volatile and shaky this afternoon. Would you read anything into this?
No, I don't think that there is anything specific, and actually more especially after the Bandhan Bank having evinced interest in the Group Finance, which is likely to be a takeover by Bandhan Bank of Group Finance. In fact, that shows the visibility for all these companies, and taking this, or maybe keeping a fundamental view. We are in fact keeping positive view on two housing finance companies. One is HDFC Limited and second is Indiabulls Housing Finance. I think that at the current level, both are holding good potential for investments.
So, since you mentioned Gru and Bandhan, and the potential deal makers, what is your advice on Bandhan? I mean, shares have been under pressure. I don't know if that's because of some kind of disappointment with the swap ratio that's being discussed.
See, Surabhi, I've said this in the morning that this will be seen the EPS decretive. If I take the 60% as a swap ratio, that means 3 shares of Bandhan to get issued for 5 shares of Group Finance, and if you work that out, the dilution is likely to, because for the Bandhan the equity will dilute by about 37%, while the PAT will get added about maybe 450 crore to the existing PAT of about 1200 crore. So that is seen EPS decretive for Bandhan Bank on the merged entity basis. FY19 EPS, which may be seen at 16 rupees, will fall to an EPS of about 15 rupees. So obviously that will not get liked by the market, and that's what I've been saying. Because Group Finance is ruling at a P multiple of maybe 48 to 50 on the current year earning, while Bandhan Bank is ruling at a P multiple of maybe about 30, 31. So if a company is acquiring such an expensive assets or an expensive business, obviously that will be seen negative for Bandhan Bank.
Mr. Tulsian, a quick word on Yes Bank with this meeting coming up? I think the meeting is on the 9th for the CEO shortlist. Some names doing the rounds, have been doing the rounds for a while. Any thoughts?
See, Prashant, again, day after tomorrow, these names will be out. Whether that happens, most probably it will be after market hour, and that will again be liked by the market, because once you see the clouds, getting removed from the uncertainties, because the 31st January is the last date, and what the media is talking, that 2 names of being talked, one of Mr. Sood and second is of Mr. Monga, and maybe 1 or 2 names if also get suggested by the banks, which they have said that they will be sending 3-4 names. Definitely that will be putting an end to the uncertainty, and obviously RBI will give the clearance to one of the candidates. So as of this one, 31st January is seen to be approaching for Rana Kapoor's terms to coming to an end, and definitely that will be seen positive. And in fact, we have been initiating or giving a buy call on Yes Bank for last 1 week based on this expected news flow, that this will be seen positive by the market.
Okay. All right, Mr. Tulsian, we'll leave it on that note for this afternoon then. Thanks very much for joining in. Those are a couple of fundamental points coming in from Mr. Tulsian. Rapid decline in the market, you'd have to say, and we are making fresh lows, 10,763, mid-cap index on the verge of turning negative. Nifty Bank has also lost quite a bit. So yes, quite a bit of decline in the last 20 minutes. How do you trade this? Some more ideas coming up with Sandeep Wagle. Sandeep, what's on your list?
Afternoon, Surbhi. I would go with a buy in a Yes Bank, stop loss of 633, target 654, and a sell in a Tata Elxsi, stop loss 995, target 945.
Okay, Sandeep, thanks very much for that. So those are a couple of trades coming your way, and we'll get you more perspective. I think, is Ashwani with us? Ashwani is with us. Ashwani, so I mean, the thesis is playing out. I mean, just 37 points left now on the Nifty.
Well, first on CNBC, as they say. See, the point is that the bulls are not getting follow through, and who takes the market lower? It's those bulls who entered today and who were hoping for more upside. I think we'll close probably very close to the lows of the session. And my sense is that, when this sort of decline happens from the highs, it generally tends to have follow through. There are very high odds that we could move lower even tomorrow.
Okay. I mean, so anything to do on the index right now, here and now, Ashwani?
Yeah, you can take fresh short positions because the market is long and long fairly strongly. So if you don't get follow through, then there will be strong profit booking. And you failed the higher level. 10,950 should have been at least touched in this rally. That wasn't touched, and midway the market turns and starts to come off. That just means that this time around the weakness is bigger than it was earlier.
Okay.
Ashwani, this is a very near-term, trade setup, or I mean, is this? Are you saying, well, maybe in some ways this looks stoppish for a while?
See, we are basically in this 10,000, 11,000 band. At 10,000, all the concerns are on the table. At 11,000, slowly things start to improve. Like at 10,000, there didn't appear life. Similarly, at 11,000, it's looking like Goldilocks.
Okay.
But the broad situation is that there is no fresh, large money that's coming in. You buy at 10,000, 10,200. You sell at 10,800. 11,000. I don't think people are going to go into an election with major positions. So it's basically range bound.
Okay. All right. On that note, let's actually welcome in our next guest on the show. Our Alpha Manager of the day, Pankaj Tibrewal of Kotak Mutual Fund, joins in. Pankaj, thanks very much. Good afternoon. And of course, it's still the new year. So let me wish you a happy new year and season's greetings. Interesting, right? 2018, lots of volatility, and investors had to learn to live with losses as well. The way things are playing out as of now, I mean, do you see 2019 to be a year of gains, big gains, or do you think it'll be more of the same, more consolidation?
A very happy new year to Surbhi, Prashant, and all your viewers. 2019, we have started on a very interesting note. So clearly, with crude prices coming down from $85 to almost at $55, $60, the macro risk has clearly taken a backseat. What is interesting is that liquidity is improving, not with the same pace as one would have expected. So in the near term, our view is that markets will be volatile because there is a large election uncertainty for the next 5 months. And even in the global markets, if you look at, there's a lot of volatility happening. On Friday, we saw how the Fed chairman spoke about that they may pause if the economy warrants it to. So clearly, we are seeing volatility across the world, and India won't be in isolation. However, we are seeing pocket of opportunities emerge in the broader market, especially in the mid and small cap segment. If you look at the divergence of Nifty versus mid and small cap, it's at historical extremes. And history suggests that whenever such divergences have happened, the next 12 months, the mid and small caps have outperformed large caps. So clearly, you are seeing bottom-up opportunities emerge in various sectors, and that's where we are focused on.
Okay, so should we talk about themes, Pankaj?
Yeah, I mean, from a theme perspective, if you look at clearly one big theme which has started to work out is that private sector corporate banks, which have been laggards for the last 5-6 years, in some of the banks we have seen leadership change, which is really exciting. Second, if you look at the NPLs, it's for the first time that the corporate NPLs have started to show signs of stabilization. Even in the RBI report, they talk about the corporate sector NPLs coming down in the first 6 months of this fiscal year, which is a good sign for private sector corporate banks. They have worked a lot on their liability franchise for even the last 5-6 years when troubled times were going on the asset side. So I think that's one interesting theme that from retail-oriented private sector banks, we may see some money shifting out towards the private sector corporate banks. The second theme, I think it's still at the nascent stage, but we are seeing early signs of capital goods recovery. In many sectors, if you talk about steel, cement, the capacity utilizations have started to move up. In the last few years, we saw government capex really spurring led by roads and railways, really spurring the infrastructure spend. Our thought is that when we interact with a lot of industry players, that early signs of private sector capex recovery started to show in, and it is led by many sectors, maybe automobiles, auto ancillary, processing industry, cement, steel, and so on and so forth. And we believe that this sector has been a dog for almost last 7 to 10 years. There have been 5 false starts in this sector, but this time it looks like to be a real one. And this is one interesting theme that over the next 2 to 3 years, this theme can actually play out. The third is cement. I think in the last 10 years, if you look at, supply has clearly exceeded demand. Demand has grown by about 5-6%, but supply has grown by 11%. In the next 5 years, we believe that this equation is going to change completely. Our thought process is that led by housing, roads, and other infrastructure projects, the demand growth is expected to be 7 to 8%, but supply growth will materially come down to 4-5% based on the announcements made by most of the cement companies for the next 2 to 3 years. Second, this industry has gone through consolidation. Now the top 10 players, in our view, will almost command 70% of the market, which used to be about less than 60% 10 years back. So hence we believe that the pricing which you have seen just 2-3% CAGR in the last 5 years in cement probably can be much higher, and cement could be one space which can create value for investors going forward. On the other side, IT, which has been a star performer last year, and rightly so, because we saw demand momentum coming back led by US and some of the other major economies, and the currency tailwind probably should be behind us this year. We expect that IT should be more in line performer rather than an outperformer this year, because currency is not showing signs of depreciation the way it did last year, and probably this year would be less exciting for currency in 2019 as macro concerns have receded. On pharma, we continue to have a stock-specific approach, and we believe that there are many good domestic pharma plays available, but at the right valuation we'll be more tempted to buy them. On autos, we are clearly seeing signs of pressure and slowdown, whether it be four-wheeler, two-wheeler. Provided government announces some populist policy, either on the rural side or for the masses, I think this sector can get a boost near the election time or post-election, where you have money in the hands of people.
Pankaj, so allow me to come in over there. In fact, that was my question, since you brought up autos, because on one hand, you do sound optimistic on revival in private sector capex, and you're saying capacity utilization levels, for instance, even in steel are picking up. But then the kind of commentary that one seems to be getting, from dealers, from the auto sector, that seems to be fairly somber. And more than the commentary, the market has punished this sector, beyond imagination already. So are the prices building in too much pessimism? Or do you think these kind of price levels are justified for stocks? I mean, the way iShares is falling, for instance.
A very interesting question. If you look at for the last 7-10 years, auto sector's weight in the index or the broader market has increased substantially, and this sector has been one of the outperformers. In the near term, we believe that yes, there are pressure points, but don't forget that in the last 2 quarters, the margin pressure which we saw in the auto led by commodity, and probably in the December quarter, the story would be the same, probably start easing from the 4th quarter or the 1st quarter of next year. So at least one pain point on the profitability, which has been margins, gets taken off because of the commodity price decline, which is steel, aluminium, copper. On the other hand, we believe that near to the election or post-election, auto may see revival coming back again. So probably when if this sector gives us opportunity in terms of long-term averages, valuation coming down, we would be tempted to increase exposure. But we had reduced exposure sometimes 6-8 months back in this sector, and in 1 or 2 of the funds, we went actually very almost zero in the sector. So that's something which we have been cognizant of. But if we get this sector at tempting valuations, we'll be more than excited to increase exposure.
The other one is capital goods that you mentioned that you like, right? I mean, there was a report earlier which kind of asked the question: is 2018 and 2019 in a way similar to 2003, 2004? You know, elections around the corner. In 2003, NDA was in power, then it lost. Some are saying, well, it could be close this time around in the general elections. Lack of any meaningful capex in the preceding few years, like back then and now. Capacity utilization is another point. Is that a valid kind of comparison, Pankaj, or do you think there are similarities, but it doesn't necessarily have to follow the same script?
So we are not asking for a very full-blown capex which we saw in 2003-04. And just to give you one data point, Prashant, in BSE 200 in 2002, the industrials and infrastructure weight was about 7%. We went to as high as 14-15%, and then we are back to 6-7% back in the BSE 200 as a weight of the entire sector. So I think that's one thought one must keep in mind, that after almost 12 years, we are back to or almost after 15 years, we are back to the same weight of BSE 200, which you used to be in 2002-03. Second, I think the order backlog, which most of the companies are sitting on, is one of the highest. Almost book-to-bill ratio is about 2.5-3 times, which gives a lot of visibility for these companies in terms of execution. Yes, it's an election year, so there may be some slowdown in terms of ordering and order inflow, but we believe that execution per se in the next 12 to 18 months could be very substantial. Third, if you travel across India, Prashant, Surbhi, we will agree that urban infra is taking off in a big way, whether it be metros, whether it be municipality work, whether it be roads. Urban infra is one thing which this country is witnessing across the states, across cities. And that's also leading to some kind of a momentum. Fourth, if you talk about affordable housing, we are constructing 13,000 houses a day. And last year, that number, which used to be 1.2 million houses in the rural areas, moved to 4.8 million. And I think that's a substantial push towards housing. So if you combine everything, yes, at the start of the cycle, one may get conflicting data points, which will not give us the confidence that the cycle has turned for good. But yes, there are early signals, which may not be a false one this time, where capacity utilizations are moving. Whichever company we are speaking to, they are either thinking of a brownfield or a greenfield. And the only worry is which government comes to power. Should we wait till May? Should we decide after the May elections, and so on and so forth? So in the next 2-3 years, our belief is that this sector can throw up opportunities which could be wealth creators.
It's an optimistic note to hear. I mean, that's good to hear, Pankaj. Since you mentioned housing, I have to ask you this very quickly. We just have 10-15 seconds left on this chat. I did notice some financial stocks in your funds. I mean, the likes of AU Small Finance, Shriram City Union. I didn't see any housing finance companies per se. Of course, some of them are also larger in terms of market capitalization, perhaps. But once the dust settles, is this something that you'd be willing to touch and hold, or stay away?
So clearly from a market capitalization, not too many companies on the housing finance side, which fits our bill. But the second derivative which we are playing as a recovery on housing is either through home building products. We are seeing a lot of traction in tile makers, maybe at some point of time plywood makers. And yes, the recovery from unorganized to organized is delayed a bit. But our belief is that going into the next 2-3 years, the country is moving towards branded products. And in the home building segment, if housing recovers, that could be an interesting play which we are playing through our portfolios.
Pankaj, it's a pleasure. Thanks very much for coming on and running us through what you make of markets, and a very extensive chat as far as sectoral view goes. So that is Pankaj Tibrewal from Kotak Mutual Fund with a perspective. There is Tata Motors, which is reporting UK JLR sales numbers up 7% year on year. That is what is coming through at this point. There's a small uptick. We'll put that in perspective in terms of, the importance of UK in the overall scheme of things. We got US numbers last, and slowly, other regions will report, and then you'd get a full idea. The market is actually, it went down to as low as being 27 points higher on the day. And so, that was the low. And we're up 44, 45 points now. So a sharp dip, and then there is an attempt at a bit of a recovery, which is underway as we speak. The Bank Nifty also is trying to pull back. It's got about 0.5%, just under 0.5% gains.